Welcome back, everybody. Well, big tech earnings reports are out, and I know we did Google already earlier in this week, but today we're breaking down Amazon, Meta, and Apple as well. Now, I will say my neighbor is doing some construction in his yard, but I really wanted to get this video out, so we're just going to kind of roll with it. If you hear some background noise, I apologize in advance, but more importantly, I know you don't care about my excuses, so let's go ahead and get started. Now, I want to start with Amazon, and I always like going back to the guidance they gave us last quarter just to see how they did based on their own expectations. And if we look, we can see that their guidance were net sales to be between $154 billion and $158.5 billion, or to grow between 8 and 11% compared to their third quarter 2023. Now, they also said they expect operating income to be between $11.5 billion and $15 billion. And if we look at what they actually reported, we see that net sales increased 11% to $158.9 billion, which is slightly above their guidance range altogether, with operating income increasing $17.4 billion. So again, operating income and revenue were both above the guidance that they gave. And if we just take a look at some of the stats here, they have operating cash flow increase 57% to $112.7 billion, and then free cash flow was $47.7 billion. But let's take a look at the breakdown by segment just to see where everything's at. So North America was up 8.7%, international up 11.7%, AWS up 19.1%. So the great part about AWS is you can clearly see that they've been on a growth acceleration trend for quite a while, basically since, Q2 2023. So over the past 5 quarters, AWS growth has been accelerating. And now you can say, hey, it's 18.7 and now it's 19.1. It's very slight acceleration, but it's still acceleration. And remember, AWS is the market leader when it comes to cloud. So being able to accelerate your growth as the leader is definitely a positive thing. And then if we scroll down to see some of the others, we see online stores, physical stores, third-party sellers still up 10%. So it's a little bit of a deceleration from previous quarters, but still double digits. And then if we look at advertising, kind of the same story, right? Like it's 18.8%, which is strong growth. There's no question about that. But it is decelerating a little bit from previous quarters. So that's just something I think to watch. But again, when you have a high margin segment that's still growing at 18.8 or basically 19%, I'm not really going to complain about that. I think that's still strong. And then lastly, subscription services is a little under 11%. So, in general for Amazon, the story that we've been talking about all year, from January when I added it to my portfolio, is that Amazon has a great profitability story going on. Their higher margin business segments are growing the fastest, and that's improving their gross margin overall. And I posted one story in a chart thing the other day that kind of showed that. So this story is still happening. Right now, the only thing you can say is the growth in these higher margin segments is slowing a little bit. And so the question we have to ask ourselves is, okay, do we expect it to grow at the same rate forever? Well, no. And as they get bigger, growth is going to slow. That's kind of natural. But I do think it's something to keep watching because advertising is an area where you have companies like Google and Meta who are the market leaders, and Amazon's ad business has been one of the fastest growing out of the 3. But it is slowing a bit, so we'll just have to see if that trend continues or if growth starts to reaccelerate in that segment. Let's go ahead and look at Amazon's presentation slides. Now, one thing I like to look at is operating income, obviously for Amazon. It's up 56% year over year. And I'm sorry, but 56% year over year in any business that is this big is very good operating income growth, even if it's slower than what it was last quarter. Now, if you look at it from the trailing 12 months, I think the trend obviously becomes a little bit more obvious because remember, a lot of Amazon's revenues are going to be seasonal because they have a big retail segment. Now, if we look at the trailing 12-month view, we can see that it's up 130% year over year, which is just astonishing growth. I mean, remember, Amazon is a huge company. It's one of the biggest companies in the world, and it's growing operating income at 130% year over year. That's just astounding. And if we look at each individual segment, we can see why. Now, the North America segment, you can see net sales are up 9%, but then operating income is up 31% year over year. If we go to international, we can see net sales is up 12% year over year, and operating income has basically changed from being a loss a year ago to being $1.3 billion in the positive. Just amazing improvement. And then if we go to AWS, net sales growth is up 19% year over year, which is really good, but operating income is up 50% year over year. So you can tell that Amazon's story is still one of, look, we're growing at a good clip, but our profitability is growing even better. And then obviously we can see that in their free cash flow slide, where it's up 123% year over year. And that includes all the investment in CapEx that they've been making, which we're going to talk about a little bit more here in a minute. But I really wanted to showcase this chart in FinChat when it relates to Amazon and their performance, because I really think that this is the key part of what makes their story so interesting, and one of the reasons why I think they have a lot of room to go, even though the stock's already performed well over the past 2-3 years. So what you see here is the operating income chart for Amazon and their three primary segments, which is North America, International, and AWS. And what you see is that for years, AWS was really the driver of operating income for the company, and that's why people used to say that AWS is the profit center for Amazon, and it's the only segment that really matters. Well, the thing that's great now is that it's not the only segment that matters. And you can see the story if we go back through history, right? Like originally, back in 2020, AWS and North America were both pretty profitable segments. But then as they got into 2022, it was basically AWS that was the only profitable segment. And that's because they were doing a lot of investment into the retail segment to try to grow profitability over the long term. And what we've seen over the past year is those investments actually bearing fruit. And you can see that the North America segment and the international segments just have a clear uptrend of operating income over the past year, to where not only is AWS earning $36 billion in operating income, now North America is earning $22 billion of operating income, and international is now positive with $2 billion of operating income. So what you have is that over the last 18 months, Amazon has changed from a company where one segment was accounting for over 100% of their operating income to where now that segment is a little over half, or maybe about 60% of their operating income. So that's a huge shift and just shows the profitability of the company is way different than it was just 18 months ago. And one of the reasons why I think this is such an important point is because you could argue that Amazon's retail segment and their logistics and distribution around that have a bigger moat than even AWS has. Because at the end of the day, who is doing that at scale the way Amazon is? The only other company that I think is even in the conversation is probably Walmart, only because they have all the brick and mortar stores around that they use as their kind of mini distribution centers to get product out quicker. And they're using things like DoorDash to be able to get one-day delivery or delivery within hours. And they're subsidizing Walmart Plus to be able to kind of push adoption to where it's not quite at the level, obviously, that Prime is, but they're trying to get there, and they're using their brick and mortar footprint to kind of give them an edge. But other than Walmart, no one is even in the conversation in terms of what Amazon does, because with Amazon, you can pay a little bit and get something you order within hours, or you can wait and get it 1 day or max 2 day for free, to where it's a point now that if you order something online and you don't get it within 2 days, you're like, what the heck's going on? It should have been here by now. Like Amazon did that. But then when you start adding things like robotics and other opportunities they have to be even more efficient going forward, I mean, who can really compete with that? There's not going to be very many, and I don't even know that Walmart can get there, but we'll just have to see. Now, one of the other things they talked about a lot was their AI business. And they said AWS's AI business is a multi-billion-dollar revenue run rate business that continues to grow at a triple-digit year-over-year percentage and is growing more than 3 times faster at this stage of its evolution as AWS itself grew. And we felt like AWS grew pretty quickly. Now, that is a huge comment, and I heard a couple people talking about it. We know AWS was a huge success for Amazon, and them saying, look, the AI business is growing like crazy, 3x faster than AWS itself grew. And so it's starting down the path of everyone questions all the CapEx spend and what ROI are we going to get. And Amazon's saying, look, this thing's growing well, and it's already a multi-billion-dollar run rate business. So that's a positive sign. And they talk about their approach a little bit more here towards the end. What he says is, on cloud, what I would tell you is that I believe we have more demand that we could fulfill if we had even more capacity today. I think pretty much everyone today has less capacity than they have demand for, and it's really primarily chips that are the area where companies could use more supply. And so we're growing at a very rapid rate, and I've grown a pretty big business here in the AI space, and it's early days. But I actually believe that the rate of growth there has a chance to improve over time as we have bigger and bigger capacity. And I think one of the reasons I mentioned in my opening comments that we have a very deep partnership with NVIDIA. Now, there's many things we can take away from this. Number one, NVIDIA shareholders, good news. And they're saying number two, the growth rate in AI could be even better than what we're experiencing now if we had more supply to be able to provide. Like the demand is so high that they can't even keep up with it. So this is Amazon saying that. I would imagine that's happening kind of across the board at the cloud providers. And that is good news for anyone invested, number one, in NVIDIA, number two, in Amazon or any of the cloud providers. And, three, anything around this AI space where everyone says it's a bubble, it's a bubble. What we're hearing out of these companies now is, you know what, it's really just getting started and we have more demand than we can actually supply. So if we take a look at what the market thinks so far about Amazon's earnings, we can see right now they're up a little over 7% on the day, right under that 200 level, which we know Jeff Bezos loves to sell at 200. So hopefully we can hurry up and get him done so we can move past it. No offense, Jeff, we love you, but come on, man. All right, so let's take a look at what they expect for next quarter. And basically, they expect net sales to be 181.5 to 188.5 billion, or grow between 7 and 11% compared to last year. Operating income they expect to be between 16 billion and 20 billion compared with the 13.2 billion from a year ago. So what this means to me is that their guidance right now for operating income is to be 20 to 50% higher in terms of operating income guidance. Like, can you just fathom what that is? Like, their conservative guidance is 20% increase in operating income for a $1.5 trillion company. That is just insane. And it makes me think back to earlier in the year when I was making changes in my portfolio. Like I dumped Hershey and I bought Google. I bought Amazon. I bought NVIDIA. And some people were very critical of those moves, saying that I was buying overpriced tech stocks and getting rid of value that's going to come back. But I don't even think it was that deep. I mean, just look at this. Their low-end conservative guidance is 20% operating income increase year over year. Their high-end guidance is 50%. They just got 56% this quarter, right? And when you look at where these companies are trading at, like if you look at Amazon right now, it's trading at what? Price to cash flow, right? Price to cash flow for Amazon is 18. And now look at a company like, let's say Starbucks, because I got rid of Starbucks too, and people were really critical of that. Price to cash flow for Starbucks is also 18. So you have one company that is saying, you know what, we're going to give you 20 to 50% operating income increase next quarter. And they're trading at an 18 price to cash flow. Where you have Starbucks where, look, we know they have a lot of issues that they need to take care of. And they're still trading at an 18 price to cash flow. Or even if we look at Hershey, like Hershey is trading at a 16.5 price to cash flow. And they basically came out and said, hey, we're not getting any earnings like all year, right? I mean, these are insane numbers. And so obviously, when I looked at these companies, I dug into their fundamentals, I dug into their business, I analyzed all that type of stuff. But sometimes you just take a step back and you're like, one company is trading an 18 price to cash flow. They're one of the most important companies in the whole world. And they're going to give me 20 to 50% operating income growth over the next quarter, like as their own guidance. To here's another company trading at the same price to cash flow multiple. They have all these headwinds. They have all these issues that they're not sure kind of what's going to happen. And why would you want that one over this one? And it was like the less I thought about it, the more obvious that it actually was, is why am I wasting time over here when look at what these companies are doing right now? Regardless of the fact that the price already doubled in the past year, you're paying for the value, not the price, right? So, at the end of the day, obviously people should invest in what they feel comfortable in. But I think sometimes we get too caught up in trying to crunch these numbers and trying to say, oh, look, this company is down and it's a bargain now, when at times it can cause us to miss the obvious things that are right in front of our faces. At least that's my take on it. So just to wrap up on Amazon, they're crushing it, and they're one of my highest conviction holdings. I've been saying it all throughout the year. That's why I made it my number 2 holding in terms of weight, right there next to NVIDIA, which is another high conviction holding. And then this third company, which is my third highest conviction holding, and we're going to talk about it next, which is Meta. All right, so let's take a look at what Meta said they expected for this quarter. Now, they expected third quarter 2024 total revenue to be around 38.5 to 41 billion, total expenses to be in the range of 96 to 99 billion, and they expected their full year capex to be in the range of 37 to 40 billion, which was increased from 35. So let's take a look at what they actually reported. Revenue for Meta was 40.5, so just under the top end of their guidance. Their costs and expenses were $23 billion, which if you extrapolate that over 4 quarters would be slightly less actually than their guidance. And then their CapEx number was about 9.2 billion. So again, if you extrapolate that, that's right at kind of 37, 38. So it's right in their guidance range, basically what they told us happened. And if we look at just the growth rates, revenue up 19%, costs and expenses actually up 14%. So it's still less than revenue. So that's good, but that's quite a bit more than it was in the previous quarter. And then operating margins were now 43%, up from 40% last year. So that's pretty good. Then obviously, last but not least, earnings per share up 37%. So just like I talked about with Amazon, right? Here's this huge company that's giving you 19% revenue growth and 37% earnings per share growth, right? And they're trading at, what are they trading at? Let me see. And they're trading at a 17 price to cash flow. Like, do you realize how ridiculous this is? Like, why would you go for some stock that's in the dumps, that's trading at the same level, that doesn't have the growth prospects or the moat or just the future outlook that these tech companies have, just because the tech companies have doubled in a year, right? Do you realize like how crazy that is? All right, I'll get off my soapbox. Let's look at the numbers here. So their family daily active people was up actually 5% year over year. Now, some people thought that this was the reason why Meta was actually down after their earnings report. You know, yes, it's slowing growth. I think previously it was like 8% or 7%. And so, yeah, coming down to 5%, I don't know that that's a huge deal. I think the reason why the stock is down is something we're going to talk about here in a minute. To me, the 5% is okay. Now, if you come down here to headcount actually increased 9% year over year. I think that's more in the ballpark of the reason why Meta traded down a little bit, just because they are kind of ramping up headcount. And they talked about it in their earnings call that they are investing in more ways than one because they see a lot of opportunity out there and they're going to go attack it. So let's take a look at Meta's earnings presentation because I think there's always some interesting stuff in here. Now, if you look at CapEx, you know, this is something that all the tech companies are saying across the board. They've increased their CapEx spend towards the end of 2024, and they expect to increase it even more in 2025. So that's going to be common across the board. Now, when you look at the family average revenue per person, this is something we talked about last quarter. I think last quarter, their growth rate was like 14%. I think this quarter, it's more around 12. So slightly slowing growth, but you have double-digit growth when it comes to average revenue per person for a company that has 3.29 billion users on an active basis. So still pretty awesome growth. Now, if you look at the ad impressions delivered kind of growth rates, you can see that there's definitely slowing here, right? So that's the number of ads that people are shown as they're in the Meta apps, right, across the board. But what you see also is that the average price per ad is something that's been a really great story for them. Now, up until this quarter, it's been pretty much across the board accelerating growth, right? That means the prices that they're able to charge their advertisers have just increased. So even as the number of ads are increasing, even at a slower rate, the price per ad is increasing, which means they're way more profitable, which is what we've seen in the numbers. Now, what you see in this quarter is that it is decelerating in some places, like rest of the world decelerated quite a bit. Asia Pacific is still accelerating, but Europe was down a little bit. US and Canada was flat, but overall, they're still up 1% from the previous quarter. Now, we're talking about quarter over quarter acceleration, right? We're not even talking about year over year growth, which is really good. So at the end of the day, again, this is a huge ad business. And I think we're nitpicking a little bit to say that, oh, look, this is decelerating, this is flat. It's overall a good story, right? Ad impressions are up, price per ad is up, and that's continuing to drive the profitability of Meta as a whole. Now, Meta was down about 4% after earnings today, but honestly, to me, they had a really good quarter. I mean, think about it. You have a company that's a $1 trillion company that had 19% revenue growth, 37% earnings per share growth, and they're trading at like a 27 PE and a 17 price to cash flow. Like, there are companies out there that would kill for that. But if that's the case, then why were they down at all, right? And to me, it really comes back down to two things. One, spending is going to increase, and they've told us that multiple times. I mean, if we look at the commentary commentary for next quarter, they already say we anticipate our full year CapEx will be in the range of 38 to 40 billion, updated from the prior range of 37. We continue to expect significant capital expenditure growth in 2025. Given this, along with the back-end weighted nature of our 2024 CapEx, we expect a significant acceleration in infrastructure expense growth next year as we recognize higher growth in depreciation and operating expenses of our expanded infrastructure fleet. And so they're saying right off the bat, expect a lot of CapEx spend because the end of 2024 is going to be crazy, 2025 is going to be even higher, and it's going to ramp up. And when we take a look at their call transcript, they talked about this as well. So Mark Zuckerberg said, first, it's clear that there are a lot of new opportunities to use AI advances to accelerate our core business that should have a strong ROI over the next few years. So I think we should invest more there. Second, our AI investments continue to require serious infrastructure, and I expect to continue investing significantly there too. We haven't decided on a final budget yet, but those are some of the directional trends I'm seeing. So the CEO is telling you straight up, be prepared for a lot of CapEx spend because one, we're seeing great potential for ROI, so I want to keep investing there and doubling down. And then two, we need serious infrastructure. And whenever I see the words serious infrastructure as it relates to AI, I think of one thing, and that's NVIDIA. So just like Amazon, even though here they didn't mention NVIDIA by name, they're basically saying, look, we're going to spend a lot of money on CapEx. This is a big deal for us. We're going to keep investing. NVIDIA is probably going to get a lot of that money. And so if you're a Meta investor, probably good news, depending on how you feel about them investing that much CapEx. But if you're an NVIDIA investor, it's definitely good news. So when you combine the fact, again, that they're increasing headcount 9% year over year, they're talking about all the CapEx they're going to spend, all the investments they're going to make that may have some good ROI in the next few years, I think people are getting a little skittish in terms of, okay, well, free cash flow is going to go down, profitability is going to go down because they're investing so much. And I think the biggest issue with Meta being down 4% is mostly that here's a stock that's been up about 80% over the past year. And you have people saying, okay, well, they're going to spend a bunch of money again. So maybe it's time to take some profits. And I think that's probably what it is. Now, overall for the outlook, I love Meta. I've been talking about Meta a lot over the past 6 months. I'm a huge fan of what they're doing. I'm a huge fan of the Orion and Ray-Ban stuff that they're doing. That's more kind of future vision stuff. I think what they're doing with Llama and AI is all very good. And when you look at their core business, it's more profitable than ever and getting more profitable. And I think that's just going to continue. And I say that even if the CapEx ramp up kind of hurts profitability in the short term, I think long term, it'll be totally worth it. Now, I talked about in the Google video earlier in the week that I was very tempted with cutting my Google stake and putting it all into Meta because of how much conviction that I had in what they're doing, especially since they announced that they're actually working on search, which I think will be a big deal. Now, I didn't get out of my Google position completely, but I did trim it yesterday specifically to put that money into Meta to where now Meta is my third largest holding by weight. Because I'm just a believer that the companies I have the most conviction in are the ones that should be the highest weight in my portfolio. So now I have NVIDIA, Amazon, and Meta, which are the three companies that I just believe the most in terms of where they're going. So I'm not really worried about Meta increasing their CapEx spend. I think Zuckerberg has shown a really good ability to execute and see things kind of before they happen. He's still relatively young. He's doing the founder mode thing. And if he thinks that's the best way to spend his money because that's where he sees the ROI, then at least in my opinion, he's probably right. But speaking of buys and sells, I actually got out of a company completely in October and added a new one, which we haven't even talked about. Now, you're going to hear about it next week in my portfolio recap. But if you were a YouTube channel member on my channel, you would have already heard about it probably like a week ago because I post all my buys and sells as they happen, as well as some portfolio valuation stuff. And I also have an ETF comparison sheet that I update every quarter that's available to channel members as well. So it's a pretty low-key, low-cost way to get a little bit of extra value and support the channel if you're interested in that type of thing. So I'll put a link in the description, and if not, just ignore it and move on. All right, so let's move on to Apple. Now, if we look at the guidance they provided from last quarter, again, Apple just kind of gives this general guidance. It's not very specific, but they said we expect our September quarter total company revenue to grow year over year at a rate similar to the June quarter, and the June quarter was about 5%. And then we expect services revenue to grow double digits at a rate similar to what we reported in the first 3 quarters of this fiscal year. Now, I wish they would just put the numbers in there. It's kind of annoying. So if we take a look what services revenue did in the first 3 quarters of the year, oh, I can't see it. Let's see if I add that now. We see that it was 14, 14, and 11. So, low double digits is what they expect. And so let's take a look at what their actual results are. They basically said the company posted quarterly revenue of $94.9 billion, up 6% year over year. So that's more than the 5 that they had last quarter. And quarterly diluted earnings per share. Let's take a look at services. Oh, actually, they don't show services here. Yeah, it really annoys me. Like, I really wish Apple would get more consistent in terms of what they put where so that you can actually see how they do it. I just feel like it's unnecessarily vague. I don't know. It's just my opinion. So if we take a look at FinChat, what we can see is that they had a little under 25 billion in service revenue for September, and that's a little under 12%. So it's right around there, 11 to 14, kind of in that range, as expected. And they had also mentioned last quarter that they expected gross margin to be between 45.5% and 46.5%. And actually, if we chart this, we can see that it was 46.2%. So that's pretty good. I mean, hitting their range in terms of their profit margin. And I think this chart tells a pretty decent story about where Apple's at. Now, we've talked many, many times on this channel about the revenue pattern for Apple, how it kind of goes in this cyclical pattern of the iPhone refresh and anytime people are buying a new iPhone. And I've talked about how I do think that pattern will probably reemerge. Now, will it be like the past where they have a really big blowout quarter? I don't know. But if you look at the pattern today, it still is kind of following what it's been doing over the past however many years, right? Like we have these spikes and then it comes down a bit. And the idea is that when they have a big iPhone refresh, then they'll have another spike again. We're getting about to the point to where that spike should hopefully happen. And I've been saying for a while that I think it'll happen over the next 12 to 18 months if it does happen. But in general, what you see here is a slowly growing profit margin, which probably equates to the fact that as service revenue grows, obviously it's much higher margin than iPhones or iPads or any hardware is going to be. And so as services revenue grows to be a larger part of their revenue mix, then their gross profit margin will grow as well. I mean, it's a pretty obvious story. Then when you look at their revenue growth, while it's not anything to write home about, it's not the 19% that Meta had or even the 11% that Amazon had, but it is 6%, which is higher than it's been since basically September of 2022. So what you hope is that this is a slow reacceleration for Apple that will hopefully grow into larger revenue growth coming soon, right? And we'll just have to see if it happens or not. And if we take a look at the breakdown by segment, I mean, again, we see the same story. iPhone's at about 5.5, so that's about what the company was at. Services, a little under 12. So yes, it's slower than it was the last 2 quarters, but overall it's still double digit and it's a hugely important part of their revenue mix now. Then if we come down, we can see, wearables is down, Mac's up slightly, iPad's up a little bit. I don't really worry about those segments all that much. I mean, yes, altogether, they do have importance, but obviously iPhone and services are really driving this company, and I think that's going to continue for a while. All right, so if we take a look at what the market thinks about Apple's report, it's down about 1.5%. Apple's been on an upswing. I mean, you can just look. It's been up 30% over the past 6 months, and that's a company that everyone says has no growth and doesn't innovate anymore, and yet it's up 30%. So, traders trade, probably taking some profits on a company that has had a really nice run over the past few months. And if you liked Apple before this earnings report, then there's nothing here that's going to change your mind. I don't think they're continuing to kind of play out what their thing's going to be. Apple Intelligence, partnering with OpenAI and other providers. And we'll just have to see if those things kind of end up being the catalyst for those big iPhone refresh cycles or not. But Apple's just kind of boring. Like, they have customers who love their product so much they don't want to leave. They're just incrementally adding new things in terms of services, becoming a bigger part of their revenue mix. They're incrementally adding features into their phones, which in my opinion is the smart thing to do because it's become such a big part of our lives now. We don't want it to have some drastic change that we don't understand. I mean, just look at what happened whenever they changed the photo app in terms of the UI, which in my opinion, it is pretty bad, at least from a personal perspective. But people got all bent out of shape of it because they changed it too much. So I don't think the issue with Apple is that they're not innovating enough. I think they're just at the stage in their life cycle to where they are a more mature company. And you could say, well, cool, that means it doesn't deserve a 30 PE, or let's see what they're actually trading at today. Yeah, a 34 PE. And maybe that's true, but I think part of the 34 PE is because of the brand strength and recognition that they have, and because of, while the growth may not be what people want it to be, you also don't have that many people that want to leave their products and services. And I think that's unique to them compared to some of their peers. So if we look for the next quarter and what Apple expects, we can see they expect their total company revenue to grow low to mid single digits year over year, so probably slightly lower than it was this quarter. And they expect the services revenue again to grow double digits at a rate similar to what we reported in the fiscal year 2024. Why do they have to say it like that? Why can't they just say we expect it to be between 11 and 15? I don't, why? And then again, they expect gross margin to be between 46 and 47, so slight bump up as services revenue continues to grow. So, I mean, look, Apple is going to be a continued hold for me. It's one of those things where, again, if you liked Apple before this earnings report, there's nothing in here that's going to probably change your mind. But, overall, big tech continues to drive the market. In my opinion, they continue to be the best companies in the market, just in general, broad strokes, right? Because they're making so much money. They're still growing pretty good for the most part, outside of maybe Apple. But I mean, you have Amazon's still growing double digits. Meta's growing 19%. Their earnings per share are like growing ridiculous amounts. I mean, these companies are just high quality companies. And I think some people are missing out on that because they look at the prices and they're looking at price only. And they're saying, look, it's up 80% in a year, so it has to come down, right? Look at the value that they're creating. Look at the earnings that they're generating. These companies have gotten cheaper in some cases than they were a year ago, even though the prices doubled. And just think about that for a second. So the way that I've been looking at it is these are the strongest companies in the market. They have some of the best outlook in terms of their, moat, their future opportunities and their growth rates, that it just is a no-brainer to have the bulk of my money in them. And I think people ask, why don't you just buy the index instead of putting all your money into the same companies? Well, I'm putting my money into those companies in a higher allocation than the index has it, because I do believe that they're going to continue outpacing the broader market in general. And I want to be more exposed to it than all the rest of the 493 other companies, with exceptions, of course. So when you look at these three companies, it's good earnings pretty much across the board. Some obviously better than others, but overall strong. And the market reaction is going to be whatever the market reaction is going to be. But it just doesn't really bother me that much. I still think these are some of the best and most obvious places to put your money because they're making a ton of cash and they're continuing to grow. But that's just me. Now, believe it or not, Amazon has been telling us pretty much what to expect from them all along. And if you missed it earlier in the year, check out my breakdown of their investor letter by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom. So keep building and stacking wins, and I'll see you on the next one. Peace.